All right, let's settle a classic debate. We're going to run a 10-year financial showdown, property versus stocks. Picture this, two investors, one in each lane. They both start with the exact same amount of money. But, as we're about to find out, this race is, well, it's anything but a fair fight. Let's see who actually comes out on top.
So this is the big question, right? You've got team property over here and team stocks over there. Give them the same pile of cash, let them run for 10 years, who wins? It's a question a lot of us have. Well, we've actually crunched the numbers, running a really detailed simulation based on real-world data to get a clear answer.
Now, to make sure this is a fair fight, the rules are super simple. Same starting cash, same monthly top-up. You get it. We're talking a true apples-to-apples comparison here. The goal is simple. Who can build more wealth over a decade? On paper, it looks like a perfectly level playing field. But, that's just in theory.
Okay, enough talk. Let's get this race started.
And, whoa, hold on a second. Right out of the gate, we've got a major plot twist. That starting line? Yeah, it's not nearly as fair as we thought. It turns out Team Property is getting hit with this massive burden before they can even take their first step.
Okay, so here's the starting line. Both racers get exactly $322,100. For our property investor, that's the down payment for a nice condo. For our stock investor, that's the entire portfolio, ready to go on day one. Seems totally even, right? Wrong.
Because get this, before the race even truly starts, Team Property gets slammed. A whopping $47,100 just vanishes. Poof, gone from their starting capital. I mean, that's like showing up to a marathon with 50-pound weights strapped to your ankles. So where did all that money go?
Well, this is what we call the friction tax. And it's not just one thing. It's a whole bunch of things. First, you've got this massive buyer stamp duty. That's $28,600 right there. Then, toss in a few grand for legal and valuation fees, and oh yeah, another 15 grand to furnish the place and get it rental ready. And here's the real kicker. None of that money, not a single dollar, goes towards your equity. It's just the cost of admission to the property game.
And this is where the real damage happens. See, that 47 grand isn't just lost for Team Property. For Team Stocks, that same 47 grand is invested and put to work from day one. That initial handicap, that friction tax, it doesn't just sit there. Over 10 years, it compounds and grows into a lead of over $120,000 for the stock investor. That is an absolutely insane head start.
So, the race is on. Let's fast forward and see how things play out over the next 10 years. That initial handicap was a huge blow, but the ongoing race? Well, it turns into a constant, month-after-month struggle for one team and a steady tailwind for the other.
Okay, look at this. For Team Property, every single month, they're bleeding cash. They have to cough up an extra $1,747 out of their own pocket just to keep the lights on for this investment. This is called negative carry, and it's basically a constant headwind, always pushing them backward in the race.
Meanwhile, what's happening with team stocks? They take that exact same amount, $1,747, and they're not just covering costs. No, they're plowing it straight into their portfolio. So every single month, that cash becomes a powerful tailwind, fueling even more growth and just widening their lead.
So, right here you see the fundamental difference. It's a tale of two cash flows. For property, that monthly commitment is a drain. It's an expense that just goes to pay down interest, taxes, and fees. But for stocks, that very same money is fuel. It's an investment that becomes part of the engine, making it bigger and more powerful every month.
So you might be wondering, how is Team Stocks pulling so far ahead? I mean, this is a pretty huge lead. It's not just about buying some stocks and hoping for the best. Nope, Team Stocks has a secret weapon in its arsenal, a strategy for actively generating extra income.
Probably the easiest way to wrap your head around this is with a simple analogy. Think of it like this. Team Stocks isn't just playing the market, they're becoming the insurance company for the stock market. They collect these regular payments, called premiums, from other investors who are nervous about which way prices are going to go.
This whole thing is called the wheel strategy, and it's basically a cycle for generating income. It's pretty cool. Step 1, you sell what's called a put option. You basically get paid cash up front for agreeing to buy a stock at a price you already wanted anyway. Step 2, if the stock drops to that price, great, you buy it at a discount. And then step 3, once you own the shares, you start collecting rent on them by selling call options. This gets you paid another premium for agreeing to sell if the price goes up. It's just a rinse and repeat cycle of collecting income.
Now, you might be thinking, this sounds too good to be true. But the reason it works over the long run is because of something called the volatility risk premium. I know, it's a fancy term, but the idea is actually pretty simple. Basically, the market consistently gets nervous and overpays for insurance, these options, to protect against big price swings. By being the one selling that insurance, you get to collect that extra bit they overpaid, and you pocket it as profit. Time and time again.
Okay, 10 long years have passed. Our two racers have been grinding it out, and now they're finally crossing the finish line. It is time for the final tally. Let's look at the scoreboard and see who won this marathon.
And here it is, the final scorecard. It really lays everything bare. Remember, they both started with the same cash, the same monthly top-up. But just look at those invisible costs for the property investor. We're talking almost $250,000, just in interest and taxes. That's staggering. And that number is exactly what makes the final net wealth figures so dramatically different.
This bar chart really says it all, doesn't it? I mean, you can't ignore these numbers. Look, the property investor didn't do badly. They ended up with over $883,000. That's a great outcome, but it's just not in the same league. The stock portfolio, without all those burdens and fueled by that constant compounding, just blew past it, finishing with over $1.2 million. It's not even close.
Let's put a fine point on it. The final difference is a massive $346,020. I mean, think about that. Over the exact same 10 years, with the same starting capital, the stock portfolio generated over $250,000 more in wealth. That is a knockout victory.
So, okay, we have a very, very clear winner. But honestly, the more interesting question isn't just who won, it's why. Why was the gap so massive? Let's do a quick post-race breakdown.
It really boils down to 4 main things. First, no friction tax for stocks. That meant a huge compounding advantage right from the starting gun. Second, they dodged all those invisible costs. We're talking almost $250,000 in interest and taxes. Third, the leverage paradox. Yeah, leverage in property can be powerful, but in this case, it came with a massive monthly bill. And lastly, taxes. The stock portfolio was just way, way more tax efficient.
And I think this quote really nails the fundamental difference here. Property is a fantastic forced savings tool. You have to make that mortgage payment, which is great for discipline. It stops you from spending that money elsewhere. But when you look at the cold, hard math, a stock portfolio is just a much, much more efficient engine for compounding your wealth. So that leaves us with one final and I think really important question for you. The math is clear, there's no debating the numbers. But that forced savings aspect of property is powerful, and a lot of people really need that built-in discipline. The stock path requires you to have the self-control to invest that money month after month without fail. So the question becomes, what's more valuable for you personally? The path that's mathematically superior, or the one that pretty much guarantees you'll build good financial habits? Only you can answer that.